All firms, companies, businesses of any description, and that includes books and movies folks, need finance in order to operate, in order to grow and expand. Where does that finance come from, you might ask? Some very kind and giving multi-millionaire who wants to help from the kindness of his heart because he sees your truest potential? Because you've been persuasive with your sad story and get real? Not a very likely scenario. There's various ways finance can be raised. Each option, like every job on planet Earth, comes with its own unique set of pros and cons. Like any firm or company, you as a freelancer trying to source funding to back your latest project, say a movie, are going to have to explore various factors when choosing the appropriate source. The finance can be categorized as internal or external. What does each mean? To clarify, internal means you effectively, your savings, capital, profits from previous work, sale of assets. Internal capital or finance tends to be a little more limited in terms of avenues available than external. External is almost limitless, but because you need to convince a third party or parties to believe in your insight and foresight, it can prove to be more time-consuming and complex. But it definitely can be done. In fact, many of the most successful brands and chains of businesses in e-commerce we see today have had external investment. External is encompassed of a bank or investor. External can be explained further and more nuanced. Long-term and short, medium-term. So let's cover long-term first. This means a share capital, loan capital, ordinary or preference shares, corporations, institutions, individuals, business angels, short and medium term. Bank overdraft, bank loan, hire purchase or HP. Supplier's credit, leasing, factoring, sale and leaseback, credit unions, loan enterprises, though these are more pertinent for startup businesses. Now, what do these periods equate to? Short term, between 1 and 2 years, this could represent working capital. Medium term, 3 to 10 years, an example would be a fixed asset, such as a vehicle. Long term, between 11 and 25 years, that would be encompassed of purchase of land or premises, perhaps a mortgage. Let's talk more about external sources of finance. Where do they come from? The best question anyone can ask. Let's start with banks. The largest providers of finance to businesses and they can offer a huge range of various forms of finance. But isn't money money, you might ask? Well, yes, but there are multiple types, such as an overdraft, a short-term borrowing method. This type of borrowing, a bank will set a limited amount to which the business can borrow, and this is frequently refused. In return of allowing the borrowing to take place, the bank will therefore set percentage fees as their charge for effectively assisting you. An overdraft is the most common form of short-term financing for businesses. This is what I often hear many filmmakers credit as means of project money, especially for traders. Although the overdraft often won't be enough alone and may need to be subsidized with other funding. This is usually done in the sense to get a digital trailer that can be sent to a producer instead of a basic written screenplay, or even book trailers. I know many people haven't heard of a book trailer unless they're in the industry, and I will talk more about this at a later date. However, for the benefit of being able to follow this content today, I'll give the layman's definition. It's basically the same as a movie trailer. Not to be confused by the fact that book trailer doesn't necessarily or is exclusively meaning a feature-length movie will be made. It's just a modern, competitive medium to show the public who may be potential customers, aka fans, readers, or viewers. Since the 21st century, it's all about captivating, compelling digital content. Next up, business loans. This would be easier for someone who is already a registered producer and/or filmmaker. A business loan is a fixed medium-term loan, usually set in terms of repayment within a limit of 3 to 10 years. Obviously, this depends per individual candidate. Commercial mortgage. This is a form of long-term finance and is typically used to buy premises or land or both. Think movie production company for this type of financial aid. How this one works is, as a large piece of property or land, or even small size and square footage is irrelevant, a piece of property or a piece of land has been purchased. This in turn, by definition, translates and equates to assets. That asset, therefore, will be the security a bank or lender will necessitate in order to safeguard their risk. In short, making the transaction less risky for them in return. This means if the business fails, say this production company doesn't work, and that's why they're neither here or there, the bank can sell the property or land to recoup its capital, fulfilling, in theory, hopefully, the agreement between the lender and the debtor. Hire purchase, alternatively abbreviated to HP, allows the business to use an asset such as machinery, think computers, registers, even a company car, without having to pay for it initially. Payment plans are too various to cover. It depends completely on the lender and the type of lender. The finance house directly buys the asset or assets directly from the supplier and retains ownership over the items for the period of the HP agreement. Think a house versus a mortgage. You obtain a mortgage for a house, but the bank retains ownership of that property until you pay your last dime. Meaning, both the purchase amount and the interest incurred stipulated at the initiation of the agreement. But how does this work with getting a production made from paper to screen? Same thesis. In fact, this is one of the better, easier, and quicker ways to start your business or recording your production. Without recorded material, you can't sell anything. With a professionally recorded and presently edited piece of digital material, you stand a chance of getting your project sold and in front of people. But you don't have all the capital necessary to purchase quality cameras, the lighting, light reflectors, software, computers, microphones, to name only a few of the items needed to film a movie or book trailer or ad. Leasing. Generally, leasing is also provided by a finance house, just like HP. A business or thinker production development has use of the asset, again, computers, cameras, microphones, etc., without having to pay for it outright. But why? Because you'll need the accessible capital you have direct access to pay for other things, like actors, locations and premises, transport, branding, props, only to name a few. You might ask, then isn't HP and leasing identical? Good question, but no, it's not. HP is different by definition. When you reach the agreed payment, otherwise known as the contract between you and the finance house, ownership will be passed over from the lender to the debtor. With leasing, it never does. The exception, unless the company is selling off items such as computers and printers or other digital devices that have a shelf life in order to replace those items with newer models. But generally, ownership never passes. A disadvantage to this is, however, you can be overpaying for something. With a direct advantage of this is by not being lumbered down with out-of-date equipment that you will either struggle to sell or not sell, or if you do sell, you won't retrieve much capital from it. Although in business, it is better to retrieve something over nothing. Whereas a major advantage to this type of finance, however, is it affords an up-and-coming business wiggle room to not have to raise large sums of capital and or be lumbered with out-of-date technology. Major bonus too is the maintenance and repair costs of the asset are not incurred by the business, and it is therefore not their responsibility. Factoring. Say you start your own production company, you probably won't have goods to sell, like equipment. You'll have a service you're selling instead, a service provided through digital transfer. This could be explained like this. We all watch and listen to YouTube. You are experiencing a digital transfer, generally a free method of education and information. So what does this mean in terms of a movie or book trailer or a feature-length movie? Instead of factual information, you're conducting a digital transfer of information. Think Netflix or any other streaming service. But factoring is the sales of goods and services on credit. It sends out an invoice which states the amount of money owed to the company. A factoring company buys these debts incurred and typically lends up to 80% of what is owed to the company that has sold the goods. The factoring company will deal with all the paperwork associated with collecting the customer debts and will charge a fee, including interest and administration costs, just like a bank, building society, or credit union. Factoring is a helpful crutch and form of short-term finance and has the benefit of helping to boost a business performance by improving a firm's cash flow. Venture capital. Have you ever been to a bank and asked to speak with a financial advisor regarding investments, stocks, and other sorts of ventures? I have in the States. There, predominantly, I found them to have much better and more extensive advice available than traditional UK banks. Not that there aren't private business advisors you can get great advice from. There is. My point is only relevant regarding traditional banking systems. Geneva, Switzerland is another great example of this. After all, it is a global hub in the financial world. Venture capital companies offer advice and financial assistance to public limited companies looking for capital. Now, this is pertinent to the UK. A public limited company is registered under the Companies Act 1980, with statutory minimum capital requirements and shares offered to the public subject to conditions of limited liability. The financial assistance could be anything from loans for venture capital, providing finance for fixed assets and working capital. Fixed assets. Assets which are purchased for long-term use and are not likely to be converted quickly into cash. Venture capital, which is a form of private equity financing. This is provided by venture capital firms or funds to startups, early stage and emerging companies that have been deemed to have high growth potential or which have demonstrated high growth. Clearly, from this you'll need to have an ironclad tight business plan to present at any and all business meetings. This differs in the other established formats in the sense that capital venture firms will offer finance assistance in return of part of your equity that additionally comes with a partial say and control of your company, essentially meaning business partners. Often this is conducted in the fashion of having a director on the board of your company. Think Lion's Den. This one is harder to achieve because you have to demonstrate the likelihood of sound business transactions prior to opening your doors for business. The pros and the cons. Venture capital is a quick way to get the capital, but could take a long time and a series of business meetings to convince third parties of your company's competence. The con, however, is handing over some degree of control of your business to third parties you might not even know in order to get started. In this case, what most people do in order to get their startup running, save the revenues from their venture and at a later date cut out on their own with that extra cash they wouldn't have had alternatively and with experience under their belt. Sale and lease back. If you're starting your own production company, you're going to need at some point an office and your business registered to that physical address for those who come across your business profile online to know you are a legitimate business and not a pop-up scammer. Therefore, sale and leaseback involves an organization selling its freehold property to an investment company and then leasing it back again over an agreed period of time. Major pro of this is that funds are then released and available for other uses immediately. Suppliers. They're your best bet. If a firm or company can negotiate credit terms with its suppliers, this means money that would otherwise have been spent at the time of the sale can be used for alternative purposes, keeping you afloat. Government assistance. There are businesses that can obtain loans or grants from the government for various purposes. Depending on where you're located, you can be available for assistance from the European Union, from the UK national government, from regional government or local government, or in some circumstances, national lottery funds and national screen agency funds, albeit lottery and screen agency funds are considered private, but screen agencies can help you obtain financing from lottery funds. Credit unions. A credit union is a type of financial institution similar to a commercial bank. For the average Joe, it's better, as it can be easier to obtain smaller loans. A credit union is a member-owned non-profit financial cooperative. Credit unions provide services to its members, similar to a bank. If you don't have an account with them, you don't qualify. They offer the same process as retail banks, including deposit accounts, provision of credit, funeral plans, and other financial services. Business angels. This is where you can have a very generous multimillionaire you know, and they decide to believe in you and your skill set. You've convinced them in your forward thinking. They liked your synopsis and screenplay, loved your movie or book trailer. So a business angel is a private individual, often with a high net worth, with business experience, and perhaps have investments in a large quantity of other businesses, who directly invest part of their assets in new and growing private businesses. Business angels can invest individually or as part of a syndicate, where one angel typically takes the lead role. Again, think Lion's Den. Share capital. Likely the most important source of funds for limited companies, as the sale of shares can raise very large amounts of capital. Shareholders receive benefits and profits in the form of cash dividends and through the possible increase in the value of their shares. Shareholders are effectively owners of the business who might have a small or large say in its operative running. In return, they enjoy limited liability. This means the maximum amount they can lose is the amount that they paid for the shares they hold. While it is possible for a limited company to issue various types of shares. Ordinary shares, alternatively known as equity shares, and they are the most common form of shares in the UK. An ordinary share gives the right to its owner to share in the profits of the limited company, otherwise known as dividends, and to vote at general meetings of the company. As profits can vary from month to month and year to year, this means that dividends paid to ordinary shareholders will vary too. Keep in mind, in bad years, you might not get paid anything, while in good years, it could run into a substantial sum. Preference shares entitle their owners to certain preferences over ordinary or equity shareholders. There are two major differences between ordinary and preference shares. Preference shareholders are often entitled to a fixed dividend even when ordinary shareholders aren't, while preference shareholders cannot typically vote at general meetings. Preference dividends are fixed shares that are often issued with the rate of dividend fixed at the time of issue. While preference shareholders have the right to be paid before ordinary shareholders, hence the term preference. Debentures. Loans for limited companies that are usually secured. A secured debenture is one that is tied to the financing of a particular asset, such as a building. Think mortgage again. The debenture holder has a legal entitlement and interest in that asset, and the company cannot dispose of it unless the debenture holder agrees. If the debenture is for something like land and/or property, it can also be referred to as a mortgage debenture. Debenture holders have the right to receive their interest payments before any dividend is payable to shareholders and, most importantly, even if a company makes a loss that particular year, it still must pay its interest charges, including interest on its debentures. Worst case scenario, if the business ultimately fails, the debenture holders will be preferential creditors and will be entitled to the payment of some of all of their money before the shareholders receive anything. Choosing a source of finance. Considerations. Cost. The business or production company or production project must ascertain how much the finance is going to cost them to obtain. Time. Consider the length of time the finance is required for, bringing that right back around to cost. Flexibility of finance. Examine how easy or difficult it will be to transfer from one source of finance to another. Status and size. Sole traders will be limited in their choice of finance, whereas public and private limited companies will have a much wider choice. Financial situation. When a business is in a disadvantaged financial situation, it may find the providers of finance are more reluctant to offer finance. If a lender is willing, the business will need to crunch the numbers to determine if a higher cost to obtain that finance will be worth it in the long run.